I think stocks took some hits. Partly was a software downturn, and then this rotation out of the Mag 7 Armies into the bullet makers for AI, and a general sort of risk-off as gold surged. But the earnings have been delivered solidly. We've been getting good economic reports, and I think positioning has gotten risk-off enough that we can sort of climb maybe in a labored way towards 7,300.
Markets rarely move in straight lines. Even in fundamentally strong environments, price action can feel confused, volatile, and disconnected from the data underneath it. That is the backdrop against which Tom Lee lays out a bold but structured case. The S&P 500 climbing towards 7,300 in the near term. This is not a euphoric call. It is not built on speculative excess or blind optimism. Instead, it rests on a careful reading of earnings strength, positioning dynamics, sector rotations, and historical behavioral patterns. According to Lee, stocks have endured a meaningful hit, driven less by collapsing fundamentals and more by multiple compression, risk-off sentiment, and sector reshuffling. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
7,300 on the S&P in the near term.
Yeah.
So are we witnessing this slow turnaround for stocks to get back on track? What do you think?
I think stocks took some hits. Partly was a software downturn, and then this rotation out of the Mag 7 Armies into the bullet makers for AI. And a general sort of risk-off as gold surged. But, the earnings have been delivered solidly. We've been getting good economic reports. And I think positioning has gotten risk-off enough that we can sort of climb maybe in a labored way towards 7,300.
Hey, how about that? Do you think, we talked about this at halftime today, are we appreciating enough how strong earnings season has been?
I think the stocks haven't reflected that because we've had a huge beat, a large percentage of companies beating. It has shown up, I guess, in small caps, but to me...
Yeah, but I mean, you know what I mean? It's like, if you said we were going to do double-digit earnings growth, and that would be a key pillar of the narrative as to why stocks were going to continue to go higher, and then we had all this volatile chop, and, we're not sure now where we're going... You just said, well, if we're going to do that kind of earnings growth, we're going to be just fine.
Yeah. I mean, there's this old adage that it takes a whole lot of E to offset PE, meaning like, you're right, the earnings have been good, but things that have affected multiples are what's causing the market to come in. The AI, a new Fed chair, potential war. So you're right. I think the fundamental anchoring is actually good. So that means stocks eventually kind of re-anchor to that and we go higher.
So you say there are three key trades. Rotation back to the Mag 7, the IGV bottoms, that's software, and crypto bottoms. But you're not suggesting that those three items have happened, are you?
Not yet, but we're maybe 90% of the way through that because I've seen some of the positioning data. So we know on for instance, prime brokerage, Goldman data, software ownership is like multi-decade lows. And then we know that the Mag 7 have gotten cheaper than the bullet makers, which has never happened in 10 years. They're 3 PE points discount. And then, of course, on the crypto side, we've already gotten to drawdowns that are basically 80% of what's been in past crypto winters. So I think those are setting up to be really big trades. Maybe they've led the market. So they bottom first, and they'll start to rally even if the market's peaking.
Does Nvidia earnings 1 week from today hold the key to the whole thing, just given the fears about AI? And the spend. And we need to get the results. We need to hear from Jensen Huang.
I mean, that could set the bottom because, if you look at the software index, this is like the 8th week of a pretty severe downturn. So next week, as you know, sometimes 9 is a big number, turning point. That could mark the bottom for software.
All right. Well, we'll have to wait.
The mention of crypto is not incidental. In Lee's framework, crypto often behaves as a high beta barometer of risk appetite. When liquidity conditions tighten or sentiment sours, crypto typically leads on the downside. Conversely, when liquidity improves or positioning resets, crypto can lead recoveries. If crypto is nearing the statistical magnitude of prior winter drawdowns, that suggests a late cycle corrective phase rather than a fresh collapse.
I did mention at the top of the show today discretionary names are strong. And one top technician says there are multiple breakouts underway, and that's hard to be negative against. Jonathan Krinsky, he joins us now at BTIG. You know, I saw your note earlier, and I wasn't sure we focused enough on these stories where you suggest restaurants continue to work higher, casinos are breaking a downtrend, airlines are taking flight, and all of those are bullish signals.
Hey, Scott. Yeah, I think, you know, when you have the narrative of the consumer is much weaker than what the consumer stocks are reflecting. And, you know, it's definitely important to look at consumer discretionary. I think it's important to look at every sector on an equal weight basis over time, but discretionary in particular, given, you know, the dominance of a few big names like Amazon. So on an equal weight basis, discretionary has been consolidating for about 6 months, does look poised to, you know, keeps pushing up against that resistance, looks poised to break through it. And then, yeah, when you look below the surface, restaurants, you know, they were in a severe bear market for a couple of years. We think they bottomed. I think late last year, they've kind of turned the corner. Airlines as a whole and the two majors, Delta and United, are above their pre-COVID resistance highs. So there's just a lot of good things working under the surface in consumer land. And again, I think what's been lost on the market as this, you know, software downturn and mega cap tech downturn has been happening is, you know, some of the rotation and some of the beneficiaries of that.
Can that be enough, the strength in these different consumer markets, to offset any sort of continued weakness within tech?
I think, you know, if the tech week, if Tom's right and software is near the bottom, and we do think we saw some capitulation in the last 2 weeks in software. So if that's kind of the general area of software, and then the key though is really semiconductors. And to your point, Nvidia next week is huge. The reaction to that will be huge because semiconductors are the largest industry group in the S&P 500 at 15%. So I think when you add it all up, if software is putting in a bottom and semiconductors don't need to, you know, continue to go higher, they just can't falter too much. So if those two things are the case, then I think there is enough strength below the surface to get that, you know, S&P finally through 7,000. But you need software to hold up, and you need semis to, you know, to not give back a ton here.
What do you think about his 7,300, you know, near-term call?
Look, I mean, we've been in a trading range from 6,800 to 7,000. So a breakup from 7,000 would, in the near term, target 7,200. So I don't think 7,300 is out of the question. Again, if you get, Mag 7 kind of resuming its uptrend, and if you get a bit of a bounce from software, I think that's definitely possible. All
right, interesting note, and I appreciate your commentary around it. That's Jonathan Krinsky, BTIG, joining us. Real quick from you, I mean, what do you make of that? These points that he makes about these different areas of discretionary making a pretty good signal.
Yeah, and discretionary bottoming kind of does make sense because consumer confidence is so low, and as you know, it's a contrarian indicator for confidence to be that bad. So discretionary should start working, but then you do start to get more things working, and it could help push the index higher.
All right, well, let's welcome in our panel to continue the conversation. CNBC contributor Hightower Stephanie Link, New Edge Wealth's Cameron Dawson, Tom Lee, of course, as you see on your picture, is still with us. How about that, Steph? You continue to talk about the consumer, and now Jonathan Krinsky has some really good data, at least technical factors within the market, to suggest that we're about to see a pickup in a lot of areas.
Well, the consumer is extremely important to the economy. It's about 70% of GDP, and services piece, which has held up remarkably well, is 75% of consumption. So that's what we root for. And I always watch the labor market, and the labor market is cooled down, but it's still pretty good. There's one job available per one unemployed person in the country. That's not so bad. And weekly jobless claims on a 4-week average is about 227,000, so still pretty low. Of course, wages are still around 3-4%. Inflation has come down, but I think the real reason that the consumer is doing better, discretionary as a whole, is because interest rates are coming down. Look at the 10-year. It peaked last year at the 10-year at 4.6%. You're at 4.8% right now. Look at the 30-year mortgage rate. It peaked a year and a half ago, closer to 8, and it is now 6.17. It's the best number since 2022, and that is leading to a broadening out within discretionary to include not only services, but the home builders, anything tied to housing has done really well. And then, of course, there are other special situations. Jonathan mentioned restaurants. I like Starbucks. McDonald's acts really well. Estee Lauder has made a major comeback from its 30% drop earlier this month. And then you can pick and choose a lot of different names. And I think that that's very, very healthy. And I also believe that while Nvidia is important next week, if Nvidia is good enough, Scott, it will drag through the pipeline better results for, the power and the grid and the data center companies. And that is really healthy. And at the same time, if you can see the software sector stabilize and see this broadening out continue, I think it's pretty healthy for the overall market.
Yet, Cameron, the market feels a little dicey, doesn't it?
Yeah, well, not to rain on the consumer parade, but if there's one thing to push back on this optimism about consumer growth, is that if you look at the equal weight consumer discretionary, which, yes, it's about to break out on an absolute basis, but if you put it next to the consumer staples, you actually see that it's really underperformed to start the year. And this has been the most important ratio, we think, for the bull market over the course of the last 3 years. The fact that discretionary has outperformed staples means that every time you've had a headline about bad consumer sentiment, the equity market was arguing that you should give the consumer the benefit of the doubt. So this ratio is still in an uptrend, but if it starts to bleed lower, making lower highs and lower lows, then that's when we would grow more cautious about the consumer. We'd grow more cautious about the U.S. economy, U.S. risk assets. That's not the call we're making, but given the underperformance to start the year, it's certainly a yellow flag to watch.
Tom, what do you think about that?
Well, I mean, to me, I think Cameron's not really raining on a parade because consumer staples is a defensive trade, and it kind of makes sense. Gold rising and tech not doing well, and I think a lot of de-risking in portfolios. So I think that's why staples and healthcare and defensives have been working. But
why is that all happening against a backdrop, as you heard Stephanie Link articulate, has so many different reasons to be positive about this market? So why are staples outperforming, at a time when, if you believe what Steph is saying, that they shouldn't be outperforming discretionary names?
I mean, I think a simple explanation is, we had 3 years of big gains for the market, and now markets are testing whether we can do a fourth year, so they want to catch their breath. That's almost also why energy materials, I think, have done so well this year, because when we looked at the end of last year, they underperformed so much over the past 5 years that they almost always snap back, and that's why it was a top sector. But I think this is a lot of mean reversion, and then when the dust settles, the bull market resumes. But I think it is a bit of congestion.
Cameron, you want to address Nvidia 1 week from today and what you think is really hanging on that report? If anything, maybe we're making too much of it, but given the recent upset around AI and the whole narrative being questioned and the spending, et cetera, feels like an especially important time to hear from this company, if nothing else.
It is important for the AI infrastructure trade, and that's really important to differentiate infrastructure versus the application. So the infrastructure side of things has been very good for a lot of different portions of the market: power generation, industrials doing better, semiconductors, of course, but the application of the AI is what certainly has dinged the software names. So I don't know if a good result from Nvidia could help lift and boost the software names. It really will come to the first quarter earnings season for those names to come out and say, look, we're not seeing AI eat our lunch. And if they do say that, of course, you could see further downside. So for that bullishness on AI infrastructure to continue, Nvidia certainly has to blow it out of the water.
And Steph, we just don't seem to have that much conviction behind the mega cap trade. What looked really good earlier today, a focal point of how we were going to open our show today, now kind of is ho-hum. I mean, okay, Nvidia is still positive, and Microsoft is as well, and Amazon is too, but now Meta's gone negative, Alphabet's gone negative, Apple's gone negative.
They're really over-owned, Scott, and there's no question about that. Like 75% of institutions own all of these names. So who is your incremental buyer, and why would they do it right now? I think you can pick and choose a couple. I'm behind Meta. I'm a smaller owner of an Amazon. But for the most part, I mean, I'm not sure what the catalyst is, because you talked about it all last week. We've talked about it. The free cash flow story has totally evaporated at some of the companies, not all of the companies. Certainly not Apple, certainly not Microsoft, but they're all getting clustered into one. And I think that there's just so many other places that people have been taking their profits and going elsewhere, because you are seeing better results in terms of earnings. And it's across the spectrum. It's been a very broad-based earnings recovery, and I think the ones that have lagged for the last 3 years to the Mag 7 are now starting to get their day, as they should, especially because the economy is hanging in at 3.5–4% growth.
Guys, we'll leave it there. Appreciate it. Steph, thank you. Cam as well. Tom, we'll see you back here.
Thank you.
At the Post sometime soon.
Tom Lee's outlook is not about dismissing volatility. It is about contextualizing it. Stocks have taken hits, not because earnings collapsed, but because multiples compressed under rotation and macro uncertainty. The earnings backbone remains intact. Positioning has turned defensive. Leadership segments are approaching statistical exhaustion points.